Welcome back. To date, this series has focused on math and structure, but even the best model fails if the person running it lacks discipline. Today, we address the most volatile variable in investing, the human mind. This is episode 6, The Psychology of Investing. This is arguably the video that I am most excited for this entire series, because this is actually what makes you money in the stock market. You can know all the numbers, all the valuation metrics, and everything about any company. But if you lack conviction and are unable to maintain your emotions during times of volatility, then you are already doomed to fail. Let's really dig in here. Standard economics relies on the rational actor. But as David Draymond, a legendary value investor, argues, we are biological survival machines. In the wild, running with the pack saved your life. In the market, following the herd is the most efficient way to destroy your capital. Crowds act as a single emotional organism. In the 1630s, tulip bulbs in Holland cost more than homes. In the mid-1920s, Florida land prices doubled in weeks. Investors bought binder contracts, small down payments on land they hadn't seen, flipping them for profit based only on the hope that the next person would be even more irrational. As you can assume, this frenzy eventually ended poorly for many uneducated investors. Institutions aren't immune. In the early 70s, professional investors piled into the Nifty 50 stocks. IBM, McDonald's, Disney were deemed as one decision stocks, basically saying these are guaranteed to do well. You could buy at one price and it's a good investment. We as educated investors understand that this is not the case. When the bubble burst, even these great businesses saw their valuations collapse by 80%. A great company is a terrible investment if the entry price is fueled by euphoria. It does not matter how fantastic a company is. Many people today point at companies like the unprofitable micronuclear reactor companies who are being bid up extremely high unjustifiably. It's easy to understand that the euphoria is built on the thesis that eventually they will sell these units for a lot of money. Retail investors fail to price in time component and the regulatory components properly. It could be years until any valuation is able to be justified because of the uncertainty. In 2000, the narrative was the new economy. At its peak, Cisco, a backbone of the internet, traded at over 100 times earnings. Yes, 100 times. That's pretty extreme. Investors believed the growth was infinite. It wasn't, at least not that quickly. It took 15 years for the stock to return to those levels. The technology was real, but the psychology was a delusion. These are the kinds of things we see in market bubble-like territory. Sometimes something that we haven't seen within the current market, at least not at these extreme levels. Today, social media and high-frequency apps compress these cycles. Algorithms prioritize engagement, which often means magnifying fear and excitement. The digital echo chamber makes the herd move faster and more violently than ever before. There we go. Our mental software has 3 major bugs. Recency bias makes us believe the next 6 months will look exactly like the last 6 months. Representativeness causes us to assume a good company is automatically a good stock, and anchoring makes us fixate on the price we paid, preventing us from selling even when the fundamentals rot. Here's my favorite topic. See, David Draymond's edge is identifying market overreaction. The market systematically overpunishes bad news, even when it's not that bad. Being a contrarian is not blindly doing the opposite. It is understanding and opposing emotional mispricing with cold, hard evidence. It is physically painful because it triggers our ancient biological fear of isolation, but it is necessary for a successful investor to spot opportunities when they arise. When someone is screaming and running for the hills, I'll be there, analyzing the investment they desperately want to get out of. Then, I'll buy it for myself. Psychologically, a loss hurts roughly twice as much as a gain feels good. This loss aversion causes investors to panic sell during temporary volatility. You must learn that volatility is merely emotional discomfort, whereas permanent capital loss is the actual long-term risk. um, Fund managers suffer from window dressing, buying popular stocks just to look correct to their clients. As John Maynard Keynes famously suggested, it is often seen as better for your reputation to fail conventionally than to succeed unconventionally. That's pretty sad, but true. People would rather go with the pack, as if it's safer, as if all the other people know something. The issue? Everyone else is just as stupid as you are. This is the part where you need to think for yourself. Pull away from the pack, stop buying garbage just because everyone else is. To fight biology, you need a firewall. Professional investors use investment journals to track their original logic, written checklists to bypass impulse, and hard valuation limits, like refusing to pay over a certain price to earnings to ensure they never chase a mania. Now, that's a very conservative stance and probably the right one. However, you need to do what you feel is right for you. Most people just buy the S&P 500 biweekly, and that is shown to be one of the best methods if you can manage to hold it long term. The market is a machine designed to transfer wealth from the impatient to the patient. It does not test your intelligence nearly as often as it tests your temperament. Master yourself, and you master the market. In episode 7, we'll look at the famous method for removing emotion, dollar cost averaging. Have a great day. Thank you for watching. Hit the like button if you enjoyed this video. Before you go, if you want to institutionalize your research process, consider securing lifetime access to ALSTOCKTRADES. Founded by Dr. Albert Allen, the platform gives you permanent, uninterrupted access to over 60 advanced analytical tools and more than 40 years of historical data, all without any necessary recurring subscription fees. To lock in this long-term value, click the link in my description down below. Use code DRAGON at checkout and take a massive $2,300 off your lifetime membership. Replace market speculation with objective, data-driven conviction today. I'll see you in the next video.